It's time now for our 360 round. Our panel will be joining us to discuss Alphabet. The company slipping this morning despite an earnings beat. Investors keying in on this massive jump in AI spending. The company says it plans to spend more than double its CapEx spending to as much as $185 billion this year. That's largely due to build out this AI data center capacity. It's an aggressive investment. It's overshadowing some strong fundamentals, including record annual sales that were above $400 billion for the very first time. So let's unpack some of these numbers, get some observations from our panel guests today. Joining us, Robert Cantwell, founder and portfolio manager at Upholdings Investment Management, and Angelo Zino, senior equity analyst at CFRA Research. Angelo, great to have you with us. You know, I just ran through a couple of the numbers, but a monster quarter for Alphabet here, but we are still seeing the stock wobbling today. Yes, the broader market is down, but Alphabet down more. You know, what are your takeaways here?
Yeah, I mean, I'd say there's two reasons why the stock is probably down. One is, the massive CapEx number that everyone's talking about. Talking about 180 billion or so in terms of the calendar 26, nearly double the level that we just saw in 25. And more importantly, what it does do is it does put downward pressure in terms of our free cash flow assumptions here in 2026 and also in future years, as we're going to assume higher CapEx spends. Now, CapEx spend. Now, I'd also say the valuation side of things also a little bit kind of on the higher side of things when you look at the other Mag 7 names, which many have gotten punished a lot more so, and kind of Alphabet holding up much better. So that premium maybe comes down a little bit. But that said, you look at the results. To your point, I mean, the numbers were phenomenal. It really was all about cloud growing 48% top line. That backlog growth here, not only this quarter but over the last 2 quarters, has been absolutely phenomenal. Provides some really great visibility over the next 2 to 3 years. And then when you even look at their other businesses, specifically search, they're finding new ways to really monetize that platform with AI, and that's really kind of led to an upward revision in terms of the growth trajectory there as well.
And Robert, I'd love to get your thoughts here too as well. Is this another case of what we've seen already this earnings season with great numbers and harder questions? Although there could be an argument made that on the call, Google really did answer a lot of the questions here about where directly that spend is going to. What were some of your thoughts?
Marley, this is a really important quarter because for 2 years now, the public market has rewarded companies for increasing their CapEx into AI infrastructure. And Google came out with a mind-boggling 40% of revenue target for their 2026 CapEx. That $180 billion, that's almost 90% of the operating cash flow they're going to generate this year. They gave Wall Street more than they asked for. And for the first time, Wall Street is now saying that might be too much. And part of what drove Google's stock up here over the past 5 months has been the success of Gemini 3, and the usage is incredible. But the revenue attached to that is so slow, and it's going to be a long time coming. And so now what public market investors are looking at is across the LLM space, there's about $50 billion of run rate revenue between ChatGPT and Claude and Gemini. But now they're seeing $600 billion of CapEx go out the door. That's a really big gap to close here. So I think those are the numbers now that investors are really starting to dial in on.
And Angelo, to that point that Robert just made here, investors have been burned before by tech overbuilding infrastructure. This isn't a news story. It's just sort of directed in a different route here. What is different this time? Are you confident that this won't become excess capacity?
Yeah, that's a great question. I mean, listen, I think you've got to be a little bit worried and cautious, especially when you get the trajectory of spend that you're now starting to see. I mean, the question is, are we at a danger zone at this point in time? When you start looking at, what we just saw, out of a company like Meta, they're hiking their CapEx spend by, 70% or so. And then, to the point here with Alphabet essentially doubling the CapEx spend. I think you've got to be worried. I think you kind of go from, green to yellow, and then you wonder, do we get to that point where we do hit, a level where maybe supply starts to exceed demand in terms of, the GPU trajectory and what have you. And at this point in time, I don't know if it's necessarily a 2026 thing, but I think you do have to start getting worried because, we've got to make sure that we start seeing those use cases really start to inflect. Not only on the enterprise AI side of things, but in this physical AI world, autonomous vehicles, all that kind of stuff? Do we start really seeing that momentum really start to inflect hard? And we're not there yet. The hope here over the next 12 to 18 months is we start seeing those inflections, and that spend that we're seeing now really starts to play out. But we just don't know the answer at this point in time.
And Robert, you said in the notes that you sent over that Google's really the only AI player that can afford to make a mistake at this level. With that said, do you view their spending as a competitive weapon? Does it give them an edge? Or have they just raised the stakes so high in this AI war that no one can exit at this point?
So all capacity eventually becomes excess capacity or dead capacity. And the thing that's different at Google, and also in Meta's case, is that they have these advertising businesses that are just a permanent source of capital here. And whether Google builds too much this year or too much last year or too much next year is 10 years from now not going to make that big of a difference, because they're still going to have all that free cash flow from their advertising business. And if you're sitting there inside of Andreessen, or if you're sitting there inside one of these large late stage VC funding companies and you're looking at Claude's investment round, or your Fidelity staring at ChatGPT, OpenAI's next investment round, you got to be frightened, because Google has just shown you that they will spend until you're gone. And that's just a really scary place to be as a private investor when you have public companies that are that large that can afford to just wipe out their operating cash flow for a few years. So at this point, we have taken all of our investment capital out of the hyperscalers where we can. The SaaS beat up is totally overblown. We've been moving money into Constellation, into Adobe. There's just so many great high return on investment opportunities that have shown up there. And at this point, we're running away from AI infrastructure.
Some really interesting perspective there. Thank you both for being with us to share that and also help us work through some of these numbers we got from Google and the reaction we're seeing to them. Robert Cantwell, founder and portfolio manager at Up Holdings Investment Management, and Angelo Zino, senior equity analyst at CFRA.